Welcome everyone to the Kindle Report. I know I missed you guys as well. I saw some comments here that you guys missed the live. Just kind of impromptu. I just finished an interview I did earlier today, so I just was kind of in the video mode. So that's a good thing. So some things to talk about here that we haven't discussed for the last few days. And if you recall, my last video was on no liquidity crisis. I actually think, I have to say, probably the most ridiculous narrative out there is that somehow everybody's going to buy T-bills and no one's going to buy stocks anymore. Meanwhile, we printed at pretty much at a 52-week high today on the S&P. S&P is now up 11.6 on the year. NASDAQ up 27%, rounding off. Russell up 5.4. Been watching the Russell. It's been exploding the last several days. So finally, we're starting to see the Russell move pretty substantially. And that has everything to do with the banks. I've been telling you for probably 5 or 6 weeks, you need to be buying these banks. The KRE was up, I think, 5.4, around 5.5%. The community banks were up. There's a lot of stuff going on, and that's driving this Russell. And that was just a matter of time. And listen, if you just look at the KRE chart, you'll see it's at the beginning phases. And I've been told I'm wrong about this bank thing, but evidently, so far, it doesn't look that way. Financials were the number one sector today from that standpoint. And so why is that if rates are going to be raised here coming as we go forward? So let's talk just a little bit of Fed talk. I know we got the big meeting next week. Big meeting next week. And what we're seeing is everybody, including the Fed funds traders, are pricing in 80% for a skip next week. I'm still on board for one more rise and then maybe a skip, or it's not even a pause, and maybe a pause forever. I've been talking to you folks about something interesting, and I'll go through a couple elements here that I think are interesting from the standpoint of, I don't know why it is I always get online that get a sniffles in my nose, but let's talk about a couple things here. And I brought this perspective in before, but I just had to talk about it. It just came up earlier today. So if we go back to the 1980s, you recall, everybody knows we were at 20% interest rates. Actually, with the surcharge on the Fed funds, effectively we were at 25%, 25%. Well, the entire 80s, by the way, had elevated rates and double digits for most of the time. I know I've talked about this before. I believe it was 1986, I got a mortgage for 13.25%. And by the way, if you look back when the rates were super high in the early 80s, some of the best GDP performance we've ever seen. I should have looked this number up, but I just go off of memory, and so far my memory works pretty good. But we were pushing potentially as high as 8% on GDP. It was insane numbers. Meanwhile, interest rates are double digit. So those of you that tell me that somehow the markets aren't going to be able to do well with higher rates and all that, I'm just here to tell you that markets will adjust. There will be some soft spots. I'm still on phase for no recession, not expecting anything to be affected. Everybody's going, well, we've only experienced the first part of the interest rates. Those are the guys that are wrong. Those are the folks that are still watching the NASDAQ up at 27%, right? So those are those guys. So, if you turn on, it's amazing. If you turn on, I watched some Bloomberg earlier today, and if you watch some of this stuff, it's absolutely amazing because everybody has the same dialogue. Everybody's talking about there's going to be less credit available. It's harder to get credit than it was last year. So what? You can still get credit. They're still selling cars. They're still doing things. There are areas that are very soft. And I saw there's an effort here. And listen, everything's right now is to make, they're attacking Joe Biden, actually almost not at the level of Trump, but everything is, they're really trying to attack everything right now from the standpoint of higher rates, and it's just going to destroy the economy. And unfortunately, folks, it's not. Look at the employment numbers we had on Friday, right? We had 339. These numbers just keep rolling at us. So we've got claims coming out in a couple of days. Really, this week is all about market sentiment. But let's go back to that 80 scenario real quick. And I'm telling you, markets will adjust and will adapt to these higher rates. And we don't have anything going on like we did then. So I guess what happened is we went from 20 down to 13 or down to 10. It was in the 90s when we saw the next level. And I still think that Bob Rubin was probably the best Treasury Secretary there ever was. He changed the duration pretty much on the U.S. debt at the time and pushed it toward the 10-year. And Europe had already done this, so he was just kind of taking that idea and restructuring the U.S. So we got away from very long yields, and so that has actually given us the ability to rotate through the early 2000s from that standpoint. But one of the things that I just want to continue to emphasize is don't fall into this trap, this negative trap. We're still seeing the database get good traction here. We're around, I haven't seen today's data. I'm doing this video a little bit early, so I'm not getting those. I won't be able to give you those numbers, but yesterday's numbers, we're at 49% on the daily, and we are right now at around, I think, 54%, 55% on the weekly or the intermediate. And so there's still forward-looking positive viewpoint on the markets for at least a minimum of 4 to 6 months, and it could rotate and be even extended beyond that. And so I guess I've really set this up pretty well. I don't think I'll be doing videos again. I'm actually considering, and so give me your thoughts. I know most of you would like to see me go live anytime, but I'm thinking this time slot could work for me to come up and do a quick update, maybe daily. I miss doing it. It actually helps me be more in sync with the markets, and that's important to me when I'm doing these daily streams. So if you're watching right now, give me a thumbs up if you like this, but more importantly, tell me what you'd like to if you'd like to see these afternoon, maybe around 6 o'clock New York time, a little bit earlier. So that's way earlier for me because I'm on Pacific time. So that would be 3 in the afternoon for me right now. So let's talk, just looking at my notes here just real quick. And I think that the scenario I want to continue to paint when it comes to the Fed is that they want out of the QT business. They're not going to suck up all the liquidity. By the way, there's about $5.5 trillion of liquid cash in the banking system right now. The whole dialogue narrative out there is somehow the Treasury is going to suck up $2 trillion and stock market's going to go down. There's not going to be any money left for stocks. And you know, this, by the way, this triggered me into another side rant, which is this. That was the scenario in 1980, 81. They were telling us that the government was going to be competing for the money to finance the debt at the time, and with the high interest rates, and the markets were going to go down. Well, 1981 is when we started a major bull market, and we rallied from 1981 through the crash of 87. And meanwhile, like I said, we had double-digit interest rates during that time. Economy ran fine. We had major expansion in business activity. Everything worked. So please, please be careful about getting locked into this scenario that what's being painted out there. The other thing is, think about this. I mean, I heard things from the World Bank and all these big players. The World Bank has never been right about anything. Peter Schiff has been right more than the World Bank. And that's not a very good record. So the point is that what I am telling you here is that we're going to see a lot of forward looking. I'm sounding really, really bullish, I know. I still am looking for, as we finish Q2, I'm looking for into the third quarter. I'm still looking for some positives, and we'll see how the data rolls out here in the future. So I'm going to go through all of the markets. I've been getting a lot of emails and tweets and other comments that I'm going to cover all the normal markets I do. So I'm going to go through those pretty quick. I want to show you a couple of things that I've been working on, getting super, super close to getting the indicators out, the new suite. So hang on, it's not long away. I did a lot of work this weekend We've got some videos we're putting together, putting all the goodies together. So let's get into some technicals here. All right, as always, I start with the hourly chart on the S&P, and I want you to look at this thing turned around pretty good. It doesn't have the PPMs on here, but it has the predictive SMAs. You can see this white line, the 10-hour moving average is moving up pretty substantial. So, and these are the numbers for the market grid from yesterday. Okay, I'll show you the market grid for today in just a minute. But what we're looking at here, this is the grid over, will be one of the new indicators you'll have. You'll be able to put the daily grid on from any symbol onto an intraday chart. And so what you'll notice here is we traded just below the S1 number and traded right up to the R1 number, and that was at 42.93.17 was R2. The high was 42.94.75, and that pretty much printed right into the close is where we got that. So that is pretty interesting. So let's go and take a look here. Same graph here, looking at, but the PPMs look like we're going to stay positive. Typical, we're getting a peak in the PPMs here in the next about 3 hours from now, but I expect that we'll be able to hold this line. And as always, about an hour before London opens, give or take, and an hour afterwards, looks like there's going to be a bit of a turning point. Maybe we'll be able to trade back in toward the 21-hour moving average, which right now is around back to 42.80, 81, possibly down into that. So let's go in and let's take a look at the daily market grid numbers here. But I want you to also, real quick here, to look at this daily chart. Look at the angle of attack here on these moving averages. It's pretty insane. This is accelerating for another day. We're almost, right now we're at 0.31, we're in trend mode. We go back about 5 days ago, we did get a model buy on the S&P. And so now what we're looking at is a peak in momentum coming in, maybe on Thursday, and then, but it's still going to be high enough, even though we're going to back off, you should be able to stay above that simple 10. That will be your support line. But this market's looking pretty bullish. And of course, all of the news guys are going to be telling you that we're in a technical bull market. Anybody that says that didn't already know that we were, you're looking at NASDAQ, like I said, up almost 27%, almost 30% on the year. That term technical, that's one of the stupidest terms I've heard in my life, is that a technical bull market. That just means you miss 20% of the move. Typical markets go up about 25 to 30% in a good year. So basically, when you say that, you've already missed it. If you just now go, oh, gee, I better buy, that's probably going to be a bad idea. I still expect that the market is going to continue on here, but this angle of attack is substantial. And as I mentioned on Sunday night's video that I did, is I'm still looking for this 44 to 45 handle to be hit. We'll see what kind of action we get, what the configuration is, what the database is doing at that time to determine whether or not we're going to be able to get this market to move beyond that level. Real quick, before moving on, I'll bring up this weekly chart, and we are finally seeing that the momentum is starting to back off just a little bit, but we're really still potentially going to trade up into the level. And I didn't go through the market grid, so I'm going backwards, going back over here to the market grid for the daily here. And we're looking at S1 4279. That's probably going to be, yesterday was very, very quiet. And we got an S1, R1, as I mentioned. For today, S1 is key. That's 79. And R1 is 42.99. I suspect we print over 4,300. We print up to 43.11. So look for S1, R2 from that standpoint. And I will be very surprised if we don't print above there. The key support is going to be this simple 10 SMA, which is light years away from where we're trading right now, 42.28. Use those hourly numbers as a better support level. So bring up an hourly chart, bring in the 10 simple moving average SMA, and that should be your best point to use as at least a short-term trigger or short-term support level. All right, folks, I'm going to roll through these pretty quick here. This is the daily NASDAQ. We continue to climb that angle of attack that I've been talking about. We are seeing a peak. It looks like Thursday is a peak here. Maybe we get a little backfilling coming into next week's Fed meeting. We'll see what sets up here. Like I said, I will do my best. If this time slot works, I may come on, see how it flows. Like I said, this helps me really stay in sync with the markets. I've always said I trade better when I'm doing daily commentary in written form or doing daily videos. That's why I do daily videos. So even though my content that I produce for the most part has a very short-term duration as far as usefulness, like the next day, maybe for a couple of days when I mention the weeklies, but it just really helps me stay in sync. So let's take a look at the NASDAQ here. And the NASDAQ, we're looking at 14,346 is that 10-period moving average. Like I said, Thursday looks like some sort of peak, and which suggests maybe we can start to test the 10-period moving average. If you look at the forecast over here on the where my cursor is, if you look at that point, it suggests that PPM1 is going to cross through its second derivative, which suggests we should test that value at that moving average. And it is rising daily, and it's rising right now by, just let me get a number for you real quick here. Yeah, it's rising by 80 handles per day. So you're looking at 15,100 or something. I'm sorry, not 14,500 plus. So that's going to be your support. So make sure you're using that current value of the SMA on the 10 as well. But this market is just finally looking like at least a peak in momentum's coming, and maybe we pull back to the average, but we should stay above that at least for the next couple sessions. All right, so we'll take a look at the Russell. This is a chart I've been just hammering on for months, actually. We're finally breaking above the this is the weekly chart, finally breaking above the 200 week. We have targets right now of 1996, 2111, and 2162 on the upside. So there's a lot of momentum starting to build. However, I hate when there's a however or a but it looks like the PPM2 is signaling more sideways. So watch for the market grid here on a weekly basis. we're going to need to get above, let me get the values here. We're going to need to get above the around 1875 plus on a weekly basis to really keep the momentum going. If we can't get above there, then look for this chart to continue. And so that's about another 20 handles higher from where we are right now. All right, so we'll take a look at the 10-year. This is also interesting. And while I was just discussing that I believe that the Fed will raise one more time, it's interesting that this is the weekly chart on the Treasuries, which is suggesting that the 10-period moving average is going to roll over, and we're going to see a slight bias to the downside on these yields. If you recall, going back several weeks ago, the expectation was to try to trade up into these Fibonacci targets, which are 401, 429, 447. We got up to a high of 385 on that run, and we backed off, and now we're right back into some of the moving averages here, which right now 366 is going to be pretty solid support from that level. So I don't expect it'll get much below that, but we should stay above these averages, with the low being 356 and 366 range. We should remain in that range for right now, but momentum is still very strong, so that 356 level is going to be very solid. So it's interesting. Let's take a quick look at the daily just to get a view of how those are looking. We're also seeing that it's got some upward momentum. We should stay above 366, 372 on the short term. Don't see anything really going on there. Let's take a look at the let's go and look at the 2-year. It's also showing that we're about to roll over. So maybe these expectations that are built into the market are going to start to affect at least the movements here on the S&P for the next several days. And one of the things that I talked about a minute ago from the standpoint of what the markets are doing, we're still seeing these auctions just get covered 2.5, 3 to 1. They'll be able to get all the money they need on the short term, and there's not going to be any suck of the liquidity that everybody's talking about. I know I sunk my putt earlier, but I needed to say it one last time so that you folks, especially if you're just spinning through this long video, that you hopefully hear that. So let's go ahead and go back and take a look at crude oil, which we haven't looked at, and there's definitely some news there. So we got the big OPEC. This is daily crude. We got the big OPEC meeting cutting. You're seeing a lot of, it's interesting, you're seeing a lot of projected daily demand cuts in crude oil right now. And why is that? Because everybody still is stuck on this recession story, and this is how everybody's pricing just about everything right now. Based on a recession that is nowhere to be found. And I still challenge, I know there's folks that are talking about it's coming. Well, remember the transitory thing? The interesting thing is, though, and I mentioned this the other night, but I still feel like, I'm going to come back up on screen here real quick. I still feel like that if I were going to give Jay Powell, and we'll call it the Fed, any type of grade, they'd get an A to an A+. They've actually done everything right in spite of everybody telling you they came in late, everything they did. Maybe they came in just right. I still am under the assumption that we're going to see inflation stay around much higher. They're not going to get to their 2% number. I think it's a 3.5 plus number. And I think inflation is going to be embedded in the markets for a long time. And I think what we will see with interest rates is that rates will have a true yield or a positive yield over inflation by at least 1% and is possibly into the 2% level. So whatever the inflation number is, you're going to see yields stay at, if they're 3.5, it's going to be 4.5 to 5. We're going to stay into that level. And like I said before, the Fed's out of the business of going through all this stuff. I know I'm in the crude oil section, but this is all relative because the pricing of this so-called recession that's coming is being priced into crude oil, into all types of things here. So if it doesn't happen, we're probably going to see some interesting things, especially after the cuts with OPEC. All right, I haven't covered gold for a while. This is the daily gold. We printed down last week down to the 1936 level. I was talking about the potential of getting down into an 18 handle. We do have some Fibonacci projections that came out today, and those new numbers are 1851, 1794, and 1759. Now, I talk about this a lot. This is probably what I call an island projection. So the indicator will pick up this algorithm, will pick up this pattern, and it will project this, but we never get to it. The only thing that I would argue here on a daily is that the Fib target 1 at the 1851 level is almost exactly at the 200. The 200 1843. So there's some possibility that we could get down there. The algos are suggesting that gold's going to stabilize here, not a big acceleration down. Since I haven't covered this for a while, we'll go over, take a look at the weekly. Like I said, we got down to 1936 2 weeks ago. Now and one of the things that I told you to watch for is that we're likely to stay above that 21 period moving average, which was exactly what we did. The low of that, the 21 period moving average last 2 weeks ago was 1939. We had a low, I just told you get that number back up, a low at 1936. So we basically went to there. We're going to hold that line. And I also have been suggesting that we would trade on gold between the 21 and the 10-week moving averages. The 10-week average right now is 1995. The 21 is 1947. And so far we've been up to a high of 82. So look for a peak around those levels. All right, finally, we'll finish here with the Bitcoin. And Bitcoin's just been kind of drifting sideways. Been a while since I covered it. We're still seeing a downward bias. The resistance that we have right now is 27, we'll call it 28,000, right at that level. Looks like we still have some down. This is weekly we're looking at here, folks. So that we still have some downward slope here. Still a possibility of getting down to between 24 and 22,000, but we have some support in the interim here at the 26,000 level. We got down right to that level the other day. Let me just bring that up. We got right to 25,878. We got a little bounce off of there, just like with the gold, these things look almost identical. And so you're going to trade between the 21 and the 10-week. These are simple moving averages. That should be your ranges that you should be able to trade around at that level. Quick snapshot of the daily. A big reversal here, rallying up, and so we traded all the way back above the averages. You can see the algos were suggesting yesterday that this would be low. So if you folks have the indicators, this is exactly what it was forecasting, this reverse. I see this pattern all the time, especially all three of the algos were suggesting that we're going to turn up on yesterday's bar, which means for today. So we got a nice reversal. It looks like it held the lows there and got a nice reversal up. Okay, folks, that's going to do it. I appreciate everybody showing up. We didn't get as many folks as we normally get because no one knows I'm doing this. So we'll figure it out. But give me a vote if you would like to see like these early podcasts for me to do a live stream early. It works out pretty good. Have a good perspective after being in front of the screens all day. So anyway, folks, thanks for watching. I do see some of the Smurfs are around. Appreciate the moderators and everything you guys do as well. So anyway, I'm not sure I'll be here tomorrow. It's possible. So make sure you hit the notification bell so you know when I come live, and subscribe if you haven't done that. And it's just a quick comment on the subscriptions. We moved up 1,000, roughly 1,000, and now it's stalling again. Where we are now, I think it's 33,700. So it's just churning again. So whatever's going on with this channel continues, and part of it is me, right? So I'm like, I'm on live, I'm not live, I'm doing weekly. Who knows what I'm actually doing? That's why you want to do the notification bell so you know when I show up. So thanks again, everybody. I appreciate everybody watching. Before you leave, hit that like button, and I will talk to you really soon. Thanks again.